Hello everyone, I'm Anyway Financial. Today, we're going to learn the most fundamental strategy in options trading, long call, which means buying call options. I'll use the Nasdaq 100 ETF, QQQ, as a real-world example to help you understand the core principles of this strategy. Let's get started. What is a long call? Simply put, it's buying call options. When you buy a call option, you acquire the right to buy the stock or ETF at a locked-in price on or before the expiration date in the future. Note that this is a right, not an obligation. You can choose to exercise it or not. The core concept is simple: when you're strongly bullish on an underlying asset, you can participate in its upward movement by buying call options. This strategy has 4 key characteristics. First, it's a bullish strategy. Second, risk is limited, you can lose at most the premium you paid. Third, profit is theoretically unlimited, the higher the stock price goes, the more you earn. Fourth, time is your enemy, as time passes, the option value decays. Now let's look at a real QQQ example. Assume today's QQQ's current price is $485.30. QQQ is an ETF that tracks the Nasdaq 100 index, primarily holding tech giants like Apple, Microsoft, and Nvidia. We'll construct a long call strategy like this. The underlying asset is QQQ, current price $485.30. We buy a call option expiring December 20th with a strike price of $490. There are 79 days until expiration. The premium for this option is $18.50 per share. Since the option's contract multiplier is 100, the total cost is $1,850. This $1,850 is the entire price we pay for acquiring this right. Notice that our chosen strike price of $490 is slightly above the current price of $485.30. This is called a slightly out of the money option. This means QQQ needs to rise for this option to generate value. Now let's analyze the risk and reward of this strategy. First, the maximum loss. Your maximum loss is $1,850, which is locked in. No matter how far QQQ falls, even if it drops to zero, as a buyer, your maximum loss is just the $1,850 premium you paid. This is the greatest advantage of long call, controlled risk. What are the conditions for this? As long as QQQ's price is below or equal to $490 at expiration, your option becomes worthless, and you lose the entire $1,850. Now for maximum profit. Theoretically, it's unlimited. Because QQQ's price can rise infinitely, your profit potential is also unlimited. The higher the stock price goes, the more you earn. For example, if QQQ rises to $550, your profit would be $550 to $490 times 100-1850 equals $4,150. If it rises to $600, profit would be $9,150. There's no cap. Finally, the break-even point. This is the most important price. The calculation formula is strike price plus premium per share, which is for 90 plus 18.50, equals $508.50. This means QQQ needs to rise from the current $485.30 to $508.50, a 4.8% increase, before you start making profit. Only above this point does your trade truly make money. Let's look at this classic profit-loss diagram. The horizontal axis is QQQ's price, and the vertical axis is your profit-loss. This curve perfectly demonstrates the characteristics of long call. The lower left shows a horizontal red line. This is your maximum loss zone. No matter how far QQQ falls, your loss is locked at $1,850. At the $490 strike price position, the curve begins to climb upward. From $490 to $508.50, this is the zone where your loss gradually decreases. $508.50 is your break-even point, where the curve crosses the zero line. Beyond $508.50, the upper right shows the unlimited green zone. This is your profit space. The higher QQQ goes, the steeper the curve, the greater the profit. Let's look at some specific examples. If QQQ falls to $480, you lose $1,850. Rises to $500, you still lose $850. Rises to $520, you start making money, profit $300. Rises to $530, profit $2,150. Rises to $550, profit $4,150. See? This is the charm of using small to win big, using $1,850 in cost to bet on unlimited upside potential. Now let me summarize the advantages and disadvantages of long call. There are for advantages: first, unlimited profit. Theoretically, QQQ can rise to any price, so your returns have no ceiling. Second, limited risk. Maximum loss of $1,850, already locked in, can't get worse. Third, high capital efficiency. You only use $1,850 to control 100 shares of QQQ, equivalent to $48,530 worth of stock. This is the power of leverage. Fourth, strong leverage effect. If QQQ surges, your investment return rate can reach several times or even dozens of times. But the disadvantages are also obvious. First, lower win rate. The stock needs to rise significantly for you to profit, and this probability is usually below 50%. Second, time decay. This is the biggest enemy. You lose time value every day. If the stock price doesn't rise, your option value slowly goes to zero. Third, higher cost. Compared to combination strategies like bull call spread, simply buying calls has higher premium costs. Fourth, you need three things to be right: direction must be right, magnitude must be sufficient, timing must be fast. All are essential. You must not only guess the direction correctly, but it also needs to rise enough and fast enough. Let's visually see how terrifying time decay is. Suppose QQQ stays flat at $485.30, how will your option value change? First day of opening, value $1,850. After 15 days, drops to $1,650, loss $200. After 30 days, drops to $1,420, loss $430. After 45 days, only $1,150 left, loss $700. After 60 days, only $800 left, more than half lost. The last 15 days, rapid decay. At 75 days, only $300 left, on expiration day it goes to zero. Notice the characteristics of time decay: relatively slow in the first 30 days, accelerates mid-term, then rapidly decays in the last 15 days, losing over $20 per day. This is why time is long call's greatest enemy. The stock price must rise fast enough to offset time decay. You can't wait, can't drag it out, you must achieve the rise quickly, or time will eat up your entire investment. So when should you use long call? There are three applicable scenarios. First, clear bullish expectation. You have sufficient reason to believe QQQ will rise significantly, not a small rise, but a big rise. Second, event-driven trading. For example, before tech giants' earnings season, you expect earnings to beat expectations. Or the Federal Reserve is about to cut rates, which is positive for tech stocks. Or there's a major technological breakthrough, like progress in the AI field. Third, as an alternative to buying shares. If you want to participate in QQQ's rise but don't want to spend over $48,000 to buy 100 shares, you can use just $1,850 to buy call options. This way you get leverage effect with controlled risk. But there are also unsuitable situations. If you're uncertain about direction or expect sideways consolidation, don't buy calls. If volatility is high and options are expensive, it's not cost-effective. Also, if time to expiration is too short, say less than 30 days, time decay will be very fast, avoid this too. Finally, let me summarize the keys to success and risk warnings. Long call success requires three keys. First, direction must be right. It must go up, sideways or down both mean losing money. Second, magnitude must be sufficient. It must not only rise but rise past the break-even point of $508.50, at least a 4.8% gain. A small rise isn't enough. Third, timing must be fast. The rise must be achieved within 79 days, the sooner the better, to avoid the erosion of time decay. Now for risk warnings, everyone please pay close attention. First, you may lose your entire principal of $1,850. This isn't to scare you, it's a fact. Second, win rate is usually below 50%. This is the price of using small to win big. Third, time decay cannot be reversed, it happens every day. Fourth, not suitable for options beginners. I recommend learning the basics for at least 3 to 6 months first. Fifth, requires continuous monitoring, you can't just buy and forget. My recommendation, single investment should not exceed 5% of total capital. Set stop losses, consider exiting at 50% loss. Take profits in time when target profit is reached. Record every trade, summarize experiences and lessons. Alright, let's summarize. Long call is the most fundamental bullish option strategy. Limited risk, unlimited profit, strong leverage effect. But lower win rate, time is the enemy. Suitable for traders who are strongly bullish, event-driven, and seeking high leverage. Not suitable for those uncertain about direction, seeking high win rates, or options beginners. Remember the formula for success: right direction plus sufficient magnitude plus fast timing, all three are essential. Alright, that's all for today's long call strategy. If you like this video, please like, subscribe, and share. Thank you everyone, see you next time.